Hello and good day. So, should you invest in mutual funds or individual funds or both? Well, to start with, I'll explain what the difference is between the two. A individual fund is a piece of a company. You're buying a tiny portion of ownership of that company. And if you bought enough of those, you could become a major power or major influence over the company. Now, you'd have to buy a very large portion, but you can perhaps eventually do so. And the idea that you are buying a partial ownership of this company is a strong, good mindset to have, to understand this is a company that you should trust to do well. And eventually, it is as a partial owner, especially if you own your own business, you can understand the cycle of being employed, running your own business, investing in other businesses, or however you will personally want to do it to become financially free and accomplish your goals. But you're buying a small part of ownership of the company in exchange for paying them money to do business and to work. Although admittedly, they usually get that immediately once they sell the stock to the market. Then the price going up, the price going down is not directly, or when you buy it, does not directly affect the amount of money that they can put out into their business. But on the other hand, a mutual fund is even smaller than a regular individual stock, in that you buy smaller portions of ownership of numerous companies. A bunch of people invest in a mutual fund. That mutual fund is partial ownership of numerous different companies. And therefore, instead of having to buy a $1,000 stock, you're buying a tiny portion of at a slower rate, in addition to balancing out between having an individual stock. The risk there, they go up, they go down, and they go up and down quite a bit. In a year, going up 10-15% and going down 10-15%, and doing that more than once is not uncommon, or not rare, certainly. However, stocks tend to go up, and mutual funds capitalize on that by, even the ones that go down and stay down, at least the ones that are doing well will go up. That will increase and make you your money. Something that tracks the S&P 500 is pretty much what the market will make. Is pretty much they're going to go up as much as the market, whether that be 8-9% or 10%, whatever it may be, averaged. Then there are funds that do worse, and then funds that do better. There are funds that will do, an average of 12%, and you can see that in the track record of over 10 years, over 20 years. They had 1 or 2 bad years, and the rest they've done exceptional, and average out, they do 12%. That's the kind of thing you're looking for. So basically, mutual funds are a lot less risky and something you can keep putting money in over and over and over and over, and just in like a couple of mutual funds to get a broad range of the market. And you don't have to, and you're a lot less risk, a lot less research needing to be done. Just the basic original understanding of figuring out which some kind of funds you want, and then keep putting it in there. Versus individual stocks, you have to research the company, or you really should research the company, know if it's safe, know it has a proper budget, it has more cash and debts. Make sure it's going to be able to survive a hard time and do well in the good times. and does it have a good prospect in the future, and is it undervalued? Figuring all that out. If you're somebody like me who kind of likes learning about investing and about companies, then that might be a good idea for you. But for most people, the risk with their money, and they don't want to have another job working on investing. So I would highly recommend learning about mutual funds and actually investing. One way or another, you should be investing to achieve financial freedom, because not only is that one of the easiest ways to achieve financial freedom, it is one of the only ways for people to make progress, make their money work for them, rather than them working for money. Now, there are other passive income ideas that will make you money long down the road, but those are based off your previous work. You put out a book, and you put out a video, you put out this, that, and it's still selling more copies down the road. But even if you don't put in a whole lot of work or any work, and right now. However, having your money, buying pieces of companies that do work, that's putting your money to work. So basically, individual stocks a lot riskier, and a lot more research should be done to be able to balance out the risk. But mutual funds, they're a lot safer. You still need to learn about them and learn which funds to invest in and that kind of thing. But once you do, just keep investing in those funds, and over 10, 20, 30, 40 years, you're going to be a multi-millionaire. And if you do it early enough, you have a good enough income, and you just keep at it, then a lot of people can very well become decamillionaires if they don't withdraw too early. And there's really and even then, you don't need to. Just by having $1 million invested in making you 10%, 12% average, you're making over $100K a year. And most people can live off that and do quite well and be very generous with it. And that's just with 1 million. And if any of you have seen the car that, $500 a month over 40 years cost you $5 million, then you can see the financial power of financial freedom. So, and power of investing and compound interest. So hopefully this helps you guys, and if you have any questions, feel free to leave them down below. And if you'd like to hear more content like this, feel free to subscribe, and have a good day.